In this short video, I want to talk about the preliminary topic of risk and return in its basic sense. I want to define what is risk, and I want to define what is return. So let's start with some basic questions, and I pulled up Yahoo Finance. Again, there are several websites where you can use or where you can access financial data. I just use Yahoo Finance, CNBC, or Bloomberg. You just find them to be a little bit more useful compared to others. So I pulled up Apple for no particular reason, and today is a Saturday, and the price that you see is as of closing on yesterday. So you can see at close July 31st, 4 p.m. Eastern Daylight Time. So $425.04 is how much you need to invest in this stock to become a partner in this company. So what you're risking is a $425.04 for one share. Now, you could lose all of this, part of this, or none of this. And these outcomes are likely. Now, how likely will define your risk level. But what you're risking is the $425.04. The level of risk, meaning how much you are going to lose and how likely is it that you're going to lose that, is your risk level. Now, how much do you earn? And that defines your return. When we're talking about bonds, for instance, we refer to this as yield. But in its basic sense, if you put down $425.04, how much are you going to get back on top of the principal that you invested in this company? Meaning, you're buying a $425 stock in investment, anything. Are you going to get your money back? And are you going to get some interest, some return? If this was a checking account, you put down $425 and you're hoping that you'll get your money back minus some commissions. And some checkings don't have a commission and even pay you a little bit of interest. So that's what we're looking for. Are you getting any interest, any return, any yield on your investment? So last year, trading 12 months, people who own Apple shares, shareholders, stockholders, they have earned within Apple's greater scheme of things, $13.19 per share. So Apple has worked, generated X billion dollars of income, and they have, over 1 billion shares held by millions of shareholders. And as a shareholder who risked $425 and change to become one shareholder in Apple, its income divided by the number of shares for you, the corresponding amount of that income for your investment was $13.19. That is how much you have earned. However, that doesn't mean that you're going to receive all of it in cash. Apple shareholders all together vote once a year based on the suggestions of the executives of Apple, whether to pay you that $13.19 or use that money to reinvest in the company. So last year, they have paid $3.28 off that $13.19 in cash to shareholders per share. The remainder amount was reinvested in your company. So in this sense, your return is $13.19. However, I put a question mark. Now, this is important. When you invest in a company, you have two main risks. You have other risks as well, but two main risks. Number one, obviously, is your company able to generate an income, and that income divided by the number of shares is your actual return. Now, again, you may not receive it all in cash as dividends, but that is your income per share. Now, the second risk is will the value of the stock stay the same? Now, again, how much you are going to receive as income or how much you're going to earn as a shareholder in the company is main risk number one. And now the main risk number two is you paid $425 for one share in this company. Now, will the value of that share, will the price of that share stay the same? Will it go down or will it go up? On a separate video, we talked about price versus value, and the value of the company may be there, but the price of a share will definitely change. I can promise you that the price of that share is going to change. Well, that's probably the only promise you're going to get, because I cannot predict whether it's going to go up or down, or is it going to go up and down based on your expectations. So let's look at this little chart and let's go back to say year to date. Notice how the very same stock, its price was $319 before this coronavirus market crash took place. It was in February the 18th. I just picked it randomly. And then during this epidemic, the price actually went down all the way down to $224 a share. Now, it is the same share. It is the same share that earns $13.19, that has earned $13.19 through trailing 12 months. So people were willing to pay $320 and change in February for the same stock, and the stock price went down to 230s just a month afterwards. It's the very same stock. But then the very same stock, people who bought it at 224, now today it is $425. It's almost double the very same stock. So then how much return? So the return then is twofold. One, how much earnings, how much income the company is going to generate for you per share. And then how much will the value of your stock, see the difference between price and value. The value may be the same and it may change, but how much will the price of the stock change from the day you buy it until the day you sell it? And if you keep it, obviously through time, history shows us that the price of stocks go up, but then not for every company. So overall, your return is how much dividend you get, how much earnings you have in the company, but mainly how much does the stock price change from the day you buy it until the day you sell it. So how likely is it that you will lose money? So looking at this particular stock, you could have lost about 50% and could have made almost about 100% in the course of 7 months because of this coronavirus epidemic. So will you lose a lot of money? Well, losing 50% right there is a lot of money. So you could, yes, you could lose a lot of money. I mean, consider that. You went from 325 all the way down to 225. You lost $100 on a $300 investment. That's a lot, right? So will you lose money? You can, you may, and on certain cases you will. Will you lose a lot of money is the question. And in the case of this epidemic, a lot of people lost a lot of money. I mean, imagine some people bought it right here and they panicked and they sold it right there because they thought it was going to go down even more. And then some people just hold it and or bought it at right that point and then carried it all the way up and then made whole lot of money. So a lot of the times people have this wishful thinking. I'm going to buy this stock is going to go $5,000 or $100,000 and I'm going to be rich. And then there's the reality. Sometimes companies file for bankruptcy. Sometimes companies just don't pan out. Sometimes they do, but it takes decades. So you have to evaluate a company with realistic glasses, not with wishful thinking. And it's not that easy. I've been doing this for some time, and I still have wishful thinking. It's nice to daydream and hope that my $100 will be $100 million someday. And sometimes, with certain companies, it can. But then your $100 also can go down to zero. So be very careful what you're investing in. There's always the opportunity cost. So if you are buying Apple $425, you could have put this money into a checking account, earn nothing, but then lose nothing. So during this epidemic, everybody said cash is king. You buy and you take risk. Any investment, a bond or a stock or a investment in a friend's firm or buying a real estate, you're taking risk. But you just put your money into a checking account and you earn nothing, but you lose nothing. And that's very important. And there are some investments that are more riskier than the others. And there are some investments that are safer than the others. And safe and risky are relative terms. Safe compared to what? And risky compared to what? But there's always an opportunity cost. Why invest in Apple and look at how the prices actually has gone up? I mean, even compared to the pre-coronavirus levels, we went from 325 to 425. Let's take a look at a company like Exxon, which is an oil company, and unfortunately for Exxon, the price did not recover. So this is pre-coronavirus levels at about $60. It went down to about 50% loss. And now it's at 42.08. So, opportunity cost, investing in Apple versus investing in Exxon. There's an opportunity cost. Investing in an ETF, a portfolio of U.S. Treasuries, for instance. This is an ETF, and I'm not suggesting anything. I'm just choosing them randomly. But this is an ETF that includes in its, if you look at the holdings, for instance, for this, you'll find that this has United States Treasury notes, relatively safer compared to municipal bonds or corporate bonds or stocks. And this is how much of this portfolio consists of these specific U.S. Treasury notes. So this is relatively relatively a safer investment. And it has currently about $22 billion in total asset value of the portfolio. And it pays about 1.74% dividend a year. And this is an ETF. It works in a little bit differently than stocks. It doesn't have operations. It invests in certain, this specific one, it buys bonds and then pays you whatever they earn on those bonds in terms of coupons and in terms of buy-sell capital gains. Now, if you look at this compared to year to date, now notice how pre-coronavirus, it was about 85. Now it's about 86. Now notice, yes, on the chart, it looks like a huge jump, but it really is not. I mean, yes, it's a positive jump per se, but it actually went from 85 to 86, about $1 change. And in fact, if you look at 1 year, all in all, the price jump is what? About 84.67 to 86.60. So about $2 of a change. So compare this $2 out of 86 to the Exxon's $60 to $30 to $40. You see how much volatility you have, how much price change you have, and how much opportunity cost you would have by holding one over the other. Now, if you talk about owning a stock, we usually consider these to be a little bit more riskier compared to investments like the US Treasury bonds. But then, there are stocks that are considered to be safer, less price volatility, right? Remember on Apple, we had 425 and then 325, 225, and then 425. Whoa, like a roller coaster, right? But then not every stock is like that. Some of them are flat. They change barely. And sometimes they're significantly worse. And sometimes they're up to your risk appetite, right? Now, so, when we talk about risk and return, when we say stocks are risky, on general, on average, yes, they are riskier investments. But then within the stocks, you have safer alternatives, and that you have riskier alternatives. If you invest in certain companies, you will take a lot of price risk, and therefore the price can plunge or skyrocket. Or you could choose a company that where you have very little price movement, and therefore you're hoping that it won't be as risky, even though there are no guarantees. Owning a bond, well, again, with a bond, we consider them relatively safer compared to stocks because they are fixed income securities, which means you buy a bond and you receive X amount of dollars in return. And hopefully the person or the company or the government who issues the bond will pay you your principal back. So with a bond, we consider them relatively safer to a stock. However, that's also up for debate. Not every company is as risky to invest in, and not every bond is as safe to invest in. And also, when you invest in a stock, you move down 50%, up 10%, down 30%. But with a bond, there's a likelihood that the issuer can default altogether and you lose all your money. So the bonds have ratings: AAA, AA, single A, and different rating agencies like Fitch and Moody's and Standard & Poor's and all of that. But for these rating companies, when they are held accountable, they say it's freedom of speech, and therefore they're just expressing their opinions and they cannot be held accountable. So that becomes a problem. So who decides which bond is a good investment, which bond is safe, and which bond is risky? Some bonds are referred to as junk bonds, and I think the name suggests that they're risky. And some bonds that pay very little, like these treasury bonds, and we consider them to be a little safer. So there is no free lunch. If you have an investment that pays very, very little, that means that they can find buyers at very good levels, and therefore we would usually consider them to be safer compared to a bond that actually pays 20% a year or 30% a year. And but even that is not a guarantee that a bond is not going to default. So, but again, bonds are in general a little safer compared to stocks. But within the bonds as a domain, you would have risky bonds like junk bonds, and then you would have safer bonds. So it's quite possible that you're going to have a bond, a junk bond, for instance, significantly more riskier than a safer stock. Or you would have a bond significantly safer than a risky stock, and vice versa. So within themselves, they have quite a variation of a risk and return. Now, how about owning a mutual fund or an ETF? Well, these are portfolios that we buy shares. So, for instance, this one that I pulled up, the SHY, that's a portfolio of U.S. Treasury bonds, and this portfolio, holds about $22 billion in change of net assets. And I showed you their holdings. They actually have significant number of different assets, but they basically say within their profile that they invest in 1 to 3 year Treasury bonds managed by a company called iShares and traded on NASDAQ, and trades like a stock, and you can just buy a share of this if you feel like investing in this. And because they have a portfolio, if one of the bonds go bad, the others will hopefully survive. And therefore, this diversification, this investing in multiple assets, multiple securities, will lower your risk. However, in an ETF like this, all of these securities are of the same caliber. I mean, if you look at this holdings, right, they're all U.S. Treasuries, and if U.S. Treasuries suffer, well, there's not much of a diversification within this ETF. But if I were to call an ETF, and again, not suggesting, it's just one of the ones that I happen to know. This is managed by a company called Vanguard, and it actually holds emerging markets, government bonds, treasuries issued or bonds issued by governments. They're referred to as emerging market governments. And let's look at the holdings. Now, this one has bonds issued by Qatar, Saudi Arabia, Russia, Petróleos Mexicanos, State of Qatar, I think this is Malaysia, Russia, Kuwait, and Colombia. And these are the percentage of the assets within the portfolio that constitute this. So now this, overall emerging markets. So if overall emerging markets suffer, this ETF will suffer. But within the emerging markets, different countries provide you with some sort of a diversification. So, Qatar, for instance, is an oil-producing country. Saudi Arabia is 2. Russia is 2. And this is obviously a petroleum bond. And, Kuwait is 2. I don't know about Colombia. But, I mean, it looks like we are pretty much oil-producing countries. Now, this would be different compared to, let's just say, EMB. And again, this is just, I happen to know for the sake of lectures. If you look at the holdings, now you have countries like Uruguay, Colombia, Peru, but you still have Qatar and Kuwait and Russia, and still oil-producing countries. But all in all, having this diversified asset base or security base would be considered relatively safer compared to owning a single security. So with respect to our risk and return, we consider stocks to be a little bit more riskier, but again, within the stocks, you would have a huge variation, and you could have stocks that are riskier than bonds, and you could have stocks that are safer than bonds. And then bonds, we consider them on average a little bit safer, but again, within the bonds, you could have bonds that are riskier than stocks or safer than stocks. But overall, if you own a share of a mutual fund or an ETF, because of that diversification offered to you by investing in a portfolio, you are in general considered to be a little bit more safer compared to investing in a single security within that domain. So, and the return should be commensurate to the amount of risk you're taking. So if you're taking a whole lot of risk, you should get a corresponding return. Now, again, the keyword here is should. Will you? We don't know. You're hoping that the promised return is, corresponding to the risk you're taking. But then again, the keyword is you're hoping. So remember this wishful thinking. But then there's the reality of it. Will you actually get the return for that risk? Because the higher the risk, the higher the return. Is that right? Not so much. Because the higher the risk, higher the promise of return. But that's not necessarily the result. Higher the risk, and you could end up losing a whole lot of money. And therefore, there is no higher risk, higher return guaranteed. There's higher risk and there's higher promise of return, not necessarily the result of return. So be careful with wishful thinking versus reality. You're hoping for a higher return and therefore you're taking higher risk, but you could end up losing a significant amount of money. And therefore, you need to learn how to evaluate risk and how to make your decisions based on how much risk you're taking and how much wishful thinking you have versus the real analysis or the realities of your investment choices. So this is this was a brief discussion of risk and return in its basic sense. Please let me know if you have any questions, and thank you for watching.